Hey, we're back at it. Let's pick up right where we left off with these share premiums. We were looking at Rab Company issuing 200,000 new shares. Do you want to dive into the step-by-step journal entries first? Or is there a specific part of this problem that's tripping you up? This down. First, we need to grab our numbers directly from the problem. We have 200,000 shares being issued. Now notice there are two different prices here. The 50 cents is the nominal value, basically the face value of the share, but the company is actually selling them for 80 cents. That extra 30 cents, that is our premium. Step one is finding out exactly how much cash is coming into the building. We use the total issue price for this. So, 200,000 shares times 80 cents gives us $160,000 in cash. Does it make sense why we use the 80 cents here instead of the 50 cents? Great question. The 50 cents is what we call the nominal value. It is like the official legal value of the share. But when a company is doing well, people are willing to pay more for it. Think of it like a limited edition sneaker. The box might say $50, but you actually pay $80 at the store. The company receives 80 cents in actual cash for every share. So for our accounting, we have to record the full amount of cash that hit the bank account. Does that help clarify why we use the 80 cents for the cash calculation? Perfect. Now that we know we've got $160,000 in cash, we have to record the journal entry. This is where we split that money into two different buckets. First, we debit cash for the full $160,000. We debit it because cash is an asset. And when assets increase, we debit them. Simple as that. Next, we fill the first bucket, share capital. This bucket only holds the nominal value. So we take our 200,000 shares and multiply them by that 50-cent nominal value we talked about. We credit share capital for $100,000. In accounting, share capital is equity, and increasing equity requires a credit. But wait, our debits and credits don't match yet. We have $60,000 left over. What do you think we should call that extra bucket for the premium? No worries. That extra bucket has a very specific name in accounting. It is called the share premium account. We calculate it by taking the difference between the price people paid and the nominal value. So 80 cents minus 50 cents gives us a 30-cent premium per share. 200,000 shares times 30 cents gives us $60,000. Let's finish that journal entry. Boom. 160,000 on the left and 100 plus 60 on the right. It balances perfectly. Why do you think we have to keep the premium in a separate account instead of just putting it all in share capital? Spot on. They are fundamentally different types of equity. Think of share capital as the base cost and share premium as the bonus the company got for being awesome. Basically, the share capital is the legal face value, and the share premium is the extra profit on the sale. If we mash them together, we'd lose that detail. Now, let's look at the final step, showing this on the statement of financial position. This is like a snapshot of the company's health right after the issue. Whoa, wait a second. Look at that share capital number. It says $150,000. But we just calculated our new issue was worth $100,000. Based on the notes, can you guess where that extra $50,000 came from? Exactly. They are ordinary shares. But here is the trick. Companies usually already have some shares issued before they do a new round. If you check the notes, they show 50,000 plus 100,000. That 50,000 was the starting balance. We added our new 100,000 from this transaction to get that total of 150,000. The share premium starts at 60,000 because this was the first time they sold shares at a premium in this example. Adding them up gives us a total equity of 210,000. That's the whole process. Before we wrap up with a summary, does that jump from the journal entry to the final statement of financial position make sense to you? All right, let's recap everything so it's crystal clear. First, we found the cash by multiplying the shares by the 80-cent price from the question. Second, we figured out the share capital. We take those same shares but multiply by the 50-cent face value specified in the prompt. Third, the premium. That's the difference between the two prices, 80 cents minus 50 cents, which gives us that $60,000 extra. Finally, we updated the statement of financial position by adding our new 100,000 to the 50,000 already sitting in the account. There you go. You've got the formulas, the sources, and the summary. Feeling like a pro at share premiums now? Not always. You only use the share premium account if the shares are sold for more than their nominal value. If the company sold those 50-cent shares for exactly 50 cents, you would just put everything into share capital and skip the premium account entirely. Basically, if issue price is higher than nominal value, you must split them up. If they're equal, it all stays in capital. Does that make sense? Boom. You've nailed it. You've got the journal entries down. You know how to handle the statement of financial position. And most importantly, you know when that premium account actually comes into play.